you, Chelsea, and I want to thank everybody for joining us today on this little cool April day. A little bit cooler than we've been used to, but still spring is here, so it's very, very beautiful. Which kind of leads me into my next or my presentation, home buying. One of my favorite things. Plus, also too, before I get started, I want to get a little bit of background information about myself. You may have some of you may have talked to me in the past, or may have seen some of my videos through TVFCU. But my name is Brian Fryer. I'm the sales manager in the mortgage department of Tennessee Valley Federal Credit Union. Our main office is located at 535 Chestnut Street in downtown Chattanooga. Some of you may be members of the credit union. If you're not, I'll just give you a little bit of background about the credit union. We are a full service financial institution. We have been around, I think, since 1936, if memory serves me correct. We are a community credit union, so we service a 13 county region. Anyone can be a member if you live, work, or worship, go to school in that 13 county region, or are related to a current member also too. You can become a member of the credit union. So if you're not currently a credit union member, we'd love to see you. We'd love for you to become a member and check us out, what we do. When I say that we are a full service financial institution, we offer savings accounts, checking accounts. We call them share accounts and draft accounts, being a credit union. We are a nonprofit organization. We also offer residential mortgage loans, which is my department. We also offer signature loans and consumer loans, car loans, boat loans, which car loans, one of the things that TVFCU is well known for. Also, we do commercial loans, business loans as well. For our business members. So just want to let you know what we do currently at the credit union, along with a long host of other items. We have many branches in the area. And let me just get back to myself and my experience in the mortgage industry. I've been in the mortgage industry going on 23 years currently. I've been in the origination mainly, in the management side of mortgage lending. Came to the credit union in 2008 and have been here ever since. TVFCU, we have been a mortgage lender for many decades. We just haven't been known until recently for mortgage loans. And that's something that we are striving for, to be the #1 lender in the Chattanooga area. So if you're looking for any type of a mortgage loan, whether it be purchasing a home, refinancing, taking out a home equity line of credit, a second mortgage, wanting to buy land, unimproved property, we definitely would love to talk to you. We are very, very competitive. We offer a lot of different rates and programs. We offer a lot of things that our competitors locally do not offer as well. So get into that later on in my presentation and get a little more detail. But basically, just want to give a little bit of background about myself and the credit union and what we do. So let's get to it. Home buying. Everybody's heard in the news lately that right now we are in a huge market for home buying. Mortgage rates are at their lowest they've been historically, honestly. Again, I've been in this business 23 years. We had a super low mortgage rates back in 2011, 12, I believe it was. And since COVID hit in March, mortgage rates have plummeted. And we have seen rates since March be lower than it was in 2011, 12. So those low rates combined with an improving economy and everything coming out of COVID, seen high demand for homes. Also, too, we are having a generation, everybody's heard of Millennials, coming into the market as well. A lot of the Millennials in their mid to late 20s, early 30s. This is the largest generation in American history currently, and they are looking for homes. So you combine all that with the low rates, this new generation of home buyers coming in, super high demand for homes, and we're seeing low inventory currently too. So that's something you want to be aware of too. There aren't a whole lot of homes out there for sale. There are people that are wanting to sell their homes, but they've got a catch-22. In order to sell their home, they have to buy another home. So do keep that in mind, that it is definitely a seller's market. So I want to give you some information here and some tips so you'll be ready whenever you go out there and looking to buy and making offers on homes. Because again, do keep in mind, it is a seller's market. A great time to buy though, because rates are very, very low, which means most people can afford something a little bit more expensive too, or a little bit more of a home than they're looking for. So with these great rates, hopefully they'll continue. They will be going up, I'm sure. Everything I've read here over the next few months, but again, they're still going to be historically low. We are right now, as far as rates, they were in the mid twos up to the low threes or mid threes, depending on what type of loan product you're getting and everything in the term, et cetera. So again, rates are fantastic. When I first came in the industry in 1998, I think rates were around 7.5%, 8%, 8.5%, maybe as low as 6.5%. Memory serves me correct, but that was considered a great rate back then. So now we're half that or less. So just kind of give you an idea historically, how rates are. Okay, so that being said, what's the very first thing you should do if you're considering purchasing a home? Let's say you're renting or living with relatives or something like that. You'll want to start off, the very first thing is budget. You'll want to look at your budget, see what your current monthly outgo is, what your debts are, what's your current, if you're paying rent, how much you're paying in rent. You'll want to look and see what kind of payment you can afford. Because you don't want to go out and buying a $600,000-$800,000 home, or looking at $600,000-$800,000 homes without knowing if you can actually afford that. So budget, you do want to look and see what you can afford. Take into account too, when you're looking at your budget and monthly payment, there are going to be some additional costs per month to that home in your payment. You could be escrowing taxes and insurance. That's homeowners insurance and property taxes. And some properties do include HOA fees, et cetera. So we'll get into that a little bit in more detail. But budget, write down, go through your budget, see what you can afford, see what your monthly outgo is. When I mean by monthly outgo, look at what car loans you might have outstanding, credit card payments, student loans. That's a big thing nowadays, especially with millennials and Gen Zers coming up. Want to look at that student loan debt that you currently have. And you want to see, what you can afford. Generally in the mortgage business, we have a certain threshold that we look at. We do look at gross income, et cetera, and your monthly outgo. But you'll personally, before you start the process, you want to look and see what you can afford. What payment is comfortable for you? You want to have an idea, because that way, if you know what you can afford, you can kind of look and see what type of home, cost-wise, that you can afford. So also want to talk about another thing too. When you're looking at budget, you want to look at your credit too and see where you stand currently with your credit. Of course, the better the credit, the better deal you're going to get. The better terms, low down payment, lower interest rate, etc. So you do want to check on that credit before you go any further, and just see where you stand. That way you don't have any surprises when you do apply. I always tell everybody there is a website you can go to called Annualcreditreport.com. Again, that's Annualcreditreport.com. This is a free service. It was set up, if I'm not mistaken, by legislation several years ago by Congress when it was passed. You can go get a free copy of each of your three bureaus. That's TransUnion, Equifax, and Experian. And you can get a free copy, one per year, that you can look at your credit and see what's on your credit currently. One thing though to note, when you do get your free copies, it does not give you your credit score. Okay, so just be aware of that. But at least you'll see what's reporting on your credit. You can see what debts are showing up or not showing up. If there's any negative items on there, if there are any collections or any tax liens or anything like that, or charge-offs, anything like that, you want to check it and make sure they are valid and accurate. If they're not, you can contact those credit bureaus. There's information from that website whenever you go to get your credit report. But that is very crucial that you know what is on your credit, if it's accurate, if it's not, and to make sure that you're going to be able to get the best deal possible. If you do have some items on credit, I do recommend trying to get those taken care of if you can, especially anything that's recent, especially the past 24 months, 12 to 24 months, anything that's negative showing up. You want to see if you can take care of those items. Okay. So again, talk about what you can afford in your budget. Also talked about, credit. You want to look at that. Next step. You know what you can afford. You've got your budget. You're pretty happy with it. Credit seems like it's in good shape, excellent shape, or good shape. So you're ready to go to the next step. Next step, I say, find a lender. find a lender and find a realtor, especially in today's market. You're going to need both, because it is a seller's market. I recommend a good realtor. Talk to friends, talk to relatives, see who they've used. If you've used a realtor in the past and they gave you great service, go with them. There are a lot of realtors in the Chattanooga area. I think last count we had was over 1,900. So there are a lot of them out there. There's some really great realtors that we work with. So I highly recommend, especially in the seller's market, you're going to need a realtor. I really, really do. Somebody can negotiate on your behalf, show you homes, and get your foot in the door, hopefully. Also, too, when you're looking for your realtor and your lender, hopefully you're going to be using TVFCU, because we do have a lot of products that some of our competitors do not have, and we'll be talking about that in a little bit here later on in my presentation. But definitely, you'll want to get a good lender, and hopefully that'll be TVFCU. Also, too, you want to look at the type of property that you're looking for and the area that you're looking in. Do you want to live closer in town to your job, or if your employment's near your home? You want to look see if you want that. You also want to look at the schools. If you have children, you want to look and see how the schools are in that area. So that's something to be aware of. Do you want to live in town? Do you want to live somewhere out more towards the country? And that's something to be mindful of. And also the type of property that you're looking for. Are you looking for a single family home, or stick-built home, as we call it? Are you looking for a condominium or a townhouse or a duplex? You want to live in one side, rent out the other side. That's possible. You can do those types of purchases. So it's a home that actually brings in income. So also we do manufactured homes, double wides. Some lenders do, but you'll want to let your lender know and your realtor know what type of home you're looking for. Do you want to live in a condominium where you do not have maintenance, to the yard or anything like that? Or are you looking for a single family home that has a big yard or something like that with a backyard? So do be mindful of that too, and do let your lender and your realtor know what type of home you're looking for. Also too, when you're talking to your lender, they're going to give you different options on the type of loan that you can do. Whether it's a longer term loan, like a 30-year fixed rate or an adjustable rate, or if you're going to be doing a shorter term rate, a loan 15-year or less. I do recommend 15 years or less, just because you build equity faster and you pay less interest. The longer term you take out that loan, that 30-year payment, the more in interest you're going to pay back. And also your interest rates are higher on the longer term loans generally. Okay. Now, that being said, I can understand not everybody can afford, a 15-year loan or a 10-year loan. Trust me, I got that. I was younger one time and had to do the longer term to, be able to afford that payment. But do be thinking about that when you're budgeting, you're looking at a 30-year loan or a 15-year loan or a 20-year loan or even a 10-year loan. So do talk to your lender about that and discuss that as well too. Also too, when you're looking at homes too, and you're working with a realtor, make sure you're checking on property taxes and see, if you have city taxes, county taxes, or both. So you do want to be mindful of that, because that is an extra expense that sometimes you might be looking in an area that's you didn't realize located in the city and they have city taxes. So just be aware of that. Also too, I do recommend, if you're going to be shopping for a home, go ahead and contact your insurance agent if you have like auto insurance or life insurance or something like that, and see if they can offer you a good deal on your homeowner's insurance. I know a lot of the insurance companies do bundling. So I know in mine, my home, I was able to get a good homeowner's insurance policy when I bundled it with my auto insurance as well. So just do think of that too. And also some of the properties that you'll be looking at, and your realtor will let you know this, do they have HOA fees? So you want to check that and make sure as well too. Also too, something that we will be doing during the loan process, but you'll want to kind of know this up front when you're looking at properties: is the property in a flood zone? If it is in a flood zone, flood insurance is required. You will have to pay the flood insurance. So just want to let you know that as well. Again, there's nothing wrong with that. You do want to protect that home, it being in a flood zone, because we are seeing much more, flooding across the United States these days, and homes being flooded. And again, you want to make sure, if you do buy a home that is in a flood zone, make sure you do have the flood insurance too. But just be aware that it would be an extra expense on the payment monthly. Let's see here. If you are selling your current home, this is another thing too. Be mindful that you want to talk to your lender if you're going to be selling that home at the same time you'll be closing on that one and closing on the home you're purchasing, or will it be later? Are you going to keep that home and maybe you rent it out or something like that? You'll want to let your lender know that as well. Okay, that's very, very important. Nowadays, if you are selling and you're buying another home, if you find another home, great. Selling it generally is not a problem, but you'll want to make sure that you let your lender know what you're going to be doing with that current property if you have a home right now and you're looking to upgrade or downgrade to another home. So again, like I said, let your lender know. So that was the second thing. Find a lender and find a realtor, discuss your options and everything. And next thing, I highly recommend when you're talking to your lender that you get pre-qualified, especially in this market today with it being such a seller's market. You'll want to make sure that you have something from your lender that states, hey, we've looked at their loan application. They are pre-qualified with us. It is on our letterhead for this purchase price, etc. That way you can give that to your realtor. Your realtor can use that as negotiation. Say, hey, they can say, hey, look, my client has been pre-qualified with TVFCU, and they have a letter that says they've been pre-qualified. We want to make an offer on this home. Okay, so it's very, very important. It's always been important, but especially in today's market, you want to make sure you are pre-qualified. Definitely get that letter in hand so you could actually make some offers on homes. And also, with it being such a seller's market, there are a lot of listing agents. That's the agent for the seller. They will not accept offers unless you have a pre-qualification letter. So just want to let you know that a lot of sellers and their realtors want to know that you are a serious buyer and that you have talked to a lender, and a lender has at least kind of looked at your scenario, looked at your credit, looked at your application, what you want to do, and you're pre-qualified. So that being said, once you have that pre-qualification letter, you are ready. You're ready to go shopping with your realtor. Your realtor is going to take that letter, make offers on any homes that you find. If you find anything and make an offer on it, if the home is not what you were pre-qualified for, say you're pre-qualified for a single family home, but yet you found a condominium, you do want to talk to your lender before executing that offer too, just to make sure that the pre-qualification is going to be valid. Okay, so because each different property type has to match the loan program you've been pre-qualified for. So do want to keep in contact with your lender, your realtor, and let them know too. That way that pre-qualification letter is going to be valid for the type of property you're purchasing. Once that you've made an offer and the seller has accepted your offer, you will be signing a contract, and they call it fully executed contract. That's where everybody signs. There will be a closing date set, a title company picked out to do the title work. Generally, that's set up by the seller, but again, that's something you can negotiate with the seller as well. So, and especially in the Chattanooga area, North Georgia area, there are lots of great title companies out there. So you definitely want to talk to your realtor about that as well. So once you have that fully executed contract, you'll want to get that to your lender as soon as possible. Hopefully it'll be TVFCU. Make sure you get it to us as soon as possible. We can have that in hand. We can go ahead and start the actual loan process. We will need that fully executed contract. And I've had people ask me, it's like, well, Brian, you've already pre-qualified me. Why do I need the contract? Can't we just go ahead and start the loan process? Well, no, not exactly. Whenever we have that, we need that purchase contract. It shows the property address, the purchase price, the closing date. We will need to send that to the appraisal company where we order the appraisal through, because the appraiser will need that a fully executed contract, as will the title company. They will need that too, so they can go ahead and we can order the title search and everything. And some people ask me, what is title work? Why do we need to have title insurance, title work and everything, or an appraisal? Your lender is going to need an appraisal generally on most loan programs. There are some exceptions to that where they can get waivers for appraisals, depending on the credit and the strength of the file. But the lender has to have an appraisal done to make sure the condition of the collateral and the value of the collateral, and make sure it's a marketable property, and it does match at least the purchase price of the home. Something we are seeing, and I'll just a little caveat here, we are seeing homes that aren't coming in for the appraised value. The purchase price is higher. So please be aware of that. If there is a difference in the two and the appraisal there's no problems with the appraisal. Value is there. Comparables look good. And it is a valid appraisal and the value is there. You'll want to go back to the negotiating table with your seller to see what you guys can work out, because we are seeing instances where people are having to pay out of pocket to make up those differences just because they want the home. Again, sometimes I don't recommend that. You don't want to pay more for a home than it's worth. But again, look at your budget, see what you can afford. Again, it is a seller's market. So be aware of that. Be very aware of that, that there are many instances nowadays, especially people are paying a little bit more than the purchase price of the home. So be aware of that. Also too, and going back to appraisal and the property that you're purchasing, something too you want to be aware of. You want to make sure that that home is in good condition with no damage or missing items, no missing cabinets, flooring not missing, no damage to the walls or exterior. And the reason I say this is because your lender is going to make sure that that home is marketable and the value is there too. So anything that's damaged or missing, you'll need to talk to the seller, and the agents need to get together about getting those repairs done prior to, because generally can't have outstanding damage or missing items on homes to be able to do a loan on it. So just an FYI on that. There are some products and programs out there. FHA, I know, has a product that you may want to talk to your lender about if there are any repairs that need to be done. But generally, most lenders are going to require those items to be fixed or repaired prior to. So do keep that in mind. Also too, a lot of people have asked me, especially in the past, and not so much today, but in the past, we've seen a lot of homes, especially after 2008, a lot of foreclosures went up for sale. And a lot of those foreclosures, in some instances, will have damage to them because nobody's lived in them. A lot of the times those were not financed when those foreclosures were purchased from individuals. They were generally cash sales a lot of times, because most of your big lenders will not allow any major damage or anything like that to the property. So, so that being said, you got the contract to us. We can go ahead and start the loan process. You will need to sign initial disclosures. These are mandated by law. Basically, we'll send you a loan estimate, your application, several other documents that you will need to sign so we can get the loan process going. We can order appraisal, et cetera. The loan estimate is one of those items. It's going to give you a breakdown of your closing costs. It's going to give you, if you want to lock your rate, what rate you're locked at. So do want to be aware that you will sign these initial disclosures up front. Once we have everything and your documentation, hopefully also too, back to the pre-qualification part, make sure when your lender gets you a list of documents that you'll need to get the loan started, that you go ahead and start getting that paperwork together. Pay stubs or W-2s, bank statements, anything like that, homeowner's insurance quote. If you're self-employed or you have rental properties, you'll want tax returns. They'll give you a detailed list of items that you'll need to start gathering. And you do want to get all this stuff together as soon as possible, because time is of the essence, especially once you sign that contract. Generally, closings are set about 30 days from the date of contract to closing. So you'll want to get your contract to your lender as soon as possible, documentation to your lender as soon as possible, because you do not want to miss that closing date. And that's another thing too that leads me, especially talking about appraisals, and this has come up with the past few weeks, with the market being so hot, we are seeing delays with some appraisers in this area. So just be aware that time is of the essence when it comes to getting things to your lender and getting things worked out, because getting that appraisal ordered is paramount, and the title work ordering that too is paramount, because again, time is of the essence. We don't want to miss closing dates. That being said, once you get the documentation to us, you've signed everything, loan process starts. Your loan is going to go to a processor. They're going to order the title work, the appraisal, verifications of employment, see if there's a flood certification, see if it's in a flood zone, plus a myriad of other items. Generally, loan process takes 3 to 4 weeks, up to 30 days to get to closing. Once everything has come back, appraisal looks good, title work looks good, your underwriter, which TVFCU here locally, we have all our underwriters locally here in Chattanooga. We underwrite everything locally. All decisions are made local. So do keep that in mind. That's something when looking at lenders, you want to look at somebody that can meet your closing date and everything. And it's we prefer local underwriting. So, and talking to someone local here too. So, once we have everything back, everything's signed off by the underwriter, it goes to closing. Closing talks to the title closer and make sure we can get everything set up for you to go to closing and sign all documents. You will get 3 days prior to your closing date, at least 3 days prior to your closing date, a closing disclosure. Your closing disclosure is your final document that you will sign along with other documents at closing, listing out who's paid for what costs, et cetera, and how much money to bring to closing. Which leads me to my next item too, the down payment money, anything as far as closing costs. You'll want to set that in your budget too when you're talking to your lender. If you do have to have a down payment, or if you're going to be paying for closing costs, or the seller is going to be paying for closing costs. That's another thing that's come up, especially in such a tight market today when you're negotiating. Not many sellers are paying for closing costs. Sometimes they are, sometimes they're not. But if they are not, you're going to have to look and see if you're going to be paying for closing costs. Do you have those funds saved? And also for down payment. And that's another thing I want to mention. TVFCU, we do have programs where there's no down payment needed for a primary residence on a single family home. So we do have that product available for borrowers. And that's something, if you call us and talk to one of my originators, you want to check and see if you might qualify for that. Again, you can put down as much as you want generally. And I do recommend that if you do want to put, 20, 30% down, I do recommend that if you can. But if you don't, we have other programs available. And also too, just to say about that program where there's no money down, we don't require a monthly PMI. And if you're not familiar with PMI, that's private mortgage insurance. And what that is if you don't put 20% down with most loan programs, you're going to have to pay a monthly payment in with your escrow, your taxes and insurance to cover it until you've paid down below 20% down or 80% loan to value. Actually, I think it's 78% loan to value is when it drops off. But do want to be aware of that when you're talking to your lender. They can kind of give you, the originator can give you an idea of if you're taking that program that does have the PMI, what that's going to run you and how long you'll have to pay that. So do keep that in mind. Again, TVFCU has programs that we do not require PMI on some of our programs. Okay. So once you've gone to closing, you've signed all your documents. Congratulations, you are currently a homeowner. Okay. So you'll get the keys, you'll be able to move in and everything. So you're a homeowner. Also too, want to mention too, as far as loan programs and post-closing, some lenders do not hold the note or the loan for servicing on their books. They will sell that loan to a secondary market investor. But some lenders, especially your credit unions and banks, do keep those loans in-house and service them. With TVFCU, we do both. We do have what we call secondary market loans that we do sell off to an investor, but we also have loans that we keep in-house and you'll make your payments to TVFCU. We call those at TVFCU, we call those portfolio loans. We keep those on our books. Those are the ones with no money down requirements, et cetera. Which is going to lead me to my last part also too. And this isn't for the home buying process. This is once you become a homeowner. And let's say a few months or years down the road, you want to do some home improvements. Say you want to put in a pool or you want to add on a room or something like that. If you have equity in the property, you can look at a refinance. You can look at either a cash out refinance, or if you have a really good rate on your first mortgage currently, you can look at a second mortgage to get that equity out of the home, or a home equity line of credit. It's a good way to access any cash if you have the equity in the property to do some home improvements, or also too, later on down the road. And let's say when you applied for your loan, you got your loan, you purchased your home, and your credit wasn't the best, but your lender was able to get you into the home with a little bit higher interest rate. But let's say, a couple of years down the road, your credit has improved, your financial situation's improved, and you want to refinance and maybe get at a lower rate than you currently have. That's what we call a rate term refinance. And I do highly recommend that. And also too, sometimes, you may be working your career, you've got a promotion, your spouse got a promotion, you're making more income. You guys might could afford going to a 15-year loan rather than a 30-year loan that you're on currently right now, which I do highly recommend. Sometimes even a 10-year loan might be the best option for you. Your payment may not go down, but your interest rate may be less, and also the interest you're going to be paying back is going to be less. So, if you're in that 30-year loan and you're 2 or 3 years in it, you put 15 or 20% down or 10% down, and you're looking at refinancing, and you may want to go to that 15-year fixed. Yes, your payment may not go lower. It may be close to it, or maybe just a little bit higher. But think about this. You've got 28 years on your mortgage. Wouldn't it be great to pay that mortgage off in 15 years or less also? So you may have kids coming up going to college. Hopefully, maybe by the time they're ready to go to college, you have your home paid off. That extra income that you're saving each month, or extra money that you would be paying out for a mortgage, you can put towards a college fund or pay for college. So do keep that in mind too. You'll want to plan for the future and what you're going to be doing with the home. So at that pretty much kind of goes over what I wanted to touch on today. I'm going to go ahead and open it up for some questions. And Chelsea, if you want to go ahead and see if we can open that up and see if we can do some questions here and get you some answers, hopefully.
Yes, we do have a couple questions in the chat. First from Jenny, she asked, once pre-qualified, how long does that last? Meaning, what if you don't find what you're looking for quickly?
Okay, great question. That's a really good question. It's going to vary from lender to lender. Okay. At TVFCU, when we give you your letter, it's generally going to be 60 days from the date that we pulled your credit for the pre-qualification. Okay. Now, that being said, and the letter is going to say, let's say you did your pre-qualification application today, and we pulled your credit. Everything looks great. We've covered everything with you. We go ahead and give you your letter, and it's dated today, 4/21. So it's going to be, your letter is going to say this letter is good for 60 days from today's date, and we'll put that date on there. Now, that being said, with TVFCU, if it does expire and you're still looking for homes, call us and we can possibly update that letter, okay? Because our credit reports are good for a certain amount of time, even past that 60-day date. But we want to talk to you about your financial situation, if things change, your not reserves, but your assets, et cetera. But yes, 60 days generally with TVFCU, that letter is good for while you're searching. But if you go past that date, just call us, talk to your lender, keep that open line of communication open, and we'll see if we can extend that, because it is taking people a while to look for homes. And I know in some instances, it can be 2, 3, 4, 5 months. But yeah, do keep in contact with your lender. We can, let you know how long that letter is going to be good for. And then we've had people, get pre-qualified. They've looked 2 or 3, 4 months, nothing. And then 6 months later, something comes up and they find it. They call back our lender, say, hey, I need to see about getting my pre-qualification letter updated, even though it had expired after 6 months. So basically, we just redo everything, pull a new credit report if we need to, and we can issue a new one to you, and you can make that offer. So great question, though. Great question.
Okay, another question. If you could please repeat the website to look at your credit annually.
That is Annualcreditreport.com. Annualcreditreport.com. And again, that was set up through legislation in a law that was passed by Congress for you to be able to get at least one free copy of each of your credit bureaus per year. So that's Equifax, TransUnion, Experian. Again, you will not get your credit score when you do get a copy of those credit reports, but at least you're going to know what's showing on your credit currently and what has showed in the past. Okay. And I think also too, now it's been a little while since I've gone on that website. You do have the option of purchasing the credit score from those credit bureaus too. I do not know the cost, I'll be honest with you, but at least you do by law get a free copy of the credit report itself. Good question.
And a question from Jackie. She asks, she's been a TVFCU customer her entire life, but she recently moved to Maryland and she wanted to know if she had to use a different lender in that area.
Well, unfortunately, TVFCU, we only lend in Tennessee, Georgia, Florida, and certain areas of Alabama. So we're not currently lending in Maryland. However, I will say, being a credit union employee and being a credit union member myself, if she's in Maryland, look up a local credit union. We want you to go to a credit union, since we are a credit union, and credit unions, I think, do a great job. I'll be honest with you, when I started with TVFCU in 2008, when I went to go do my job interview, I'd never stepped foot into a credit union. And I will say, being in the mortgage industry, coming to a credit union, it is a different feel. Is very much like family, and credit unions do strive to take really good care of their members as best they can. So if you are in Maryland, I would look at a local credit union up there and see what you could find, and go with them if you can at all possible.
Okay, next question from Audrey. She asks, what about first-time home buyers?
First-time home buyers. There are different programs out there for first-time home buyers. TVFCU has a couple of different programs. We have a Home Possible, which is through Freddie Mac. That is a loan that we do sell in the secondary market, but generally requires only 3% down. There is a home buyer education class that's required for this, and there are income limits, but that's something you can talk to your lender about. Again, low down payment, great terms, low rate, does up to a 30-year fixed rate, 20-year fixed rate, 15-year fixed rate. So that is a great product for first-time home buyers. Gifts funds are allowed through relatives. So if you don't have money to put down, you can get a gift from the relative, from mom, dad. They can give you a gift that doesn't have to be paid back. Okay, the relative does have to sign a letter stating that this is a gift, doesn't have to be paid back. But that is a great program called Home Possible, something that TVFCU offers. We also, in our portfolio, we do the 100% financing on purchase price with no money down. We also have that as well. Also, too, keep in mind too, when we're talking about down payments and first-time home buyer and all that, closing costs. There are two ways to pay for the closing costs. As I was talking about earlier, the seller can pay them or the buyer can pay them. One of the two will have to pay those. So there are some limits on some programs what the buyer or the seller can pay, but also, of course, if you're going to be paying those closing cost funds can be a gift as well in some circumstances, in most circumstances actually. So good question there too. Very good question.
A question from Janet. She wants to know what type of mortgage loans do you offer?
Okay, well, we offer a ton. Purchases, refinances, home equity lines of credit, second mortgages. We also offer investment property purchases or loans if you want to buy investment property. Also offer unimproved property. That's a big thing right now that's going on right now. A lot of buyers are looking for homes. They can't find a home, but they do find some vacant land that's residential. TVFCU does offer a great product on that. We only require 5% down. In some instances, depending on your credit and your credit profile, a lot of our competition requires 20, 30, 40% down on vacant land. So that's a big product that we have as well. But main thing is you'll want to talk to your lender and see what programs they have too, because some things might work. A 30-year fixed rate might work for one borrower, whereas a 15-year fixed rate might work for another. Adjustable rate mortgages, those are still there. They're not like the old ones that were used in the subprime days with the super high interest rates. Your adjustable rate mortgages now, especially with TVFCU, are going to be a fixed rate for a term of like 7 years or 10 years on a 30-year amortization. It gives you time to get in the home with a lower interest rate and a lower payment, build some equity, or rebuild your credit to get some better credit and refinance later on. Or if you're looking at selling the home, say, hey, I'm only going to live this home 3 or 4 years. I know I'm going to be moving, but I want to buy a home now, build some equity. An adjustable rate mortgage might be right for you because it's a 30-year loan, but the first 7 years or 10 years, depending on which ARM product you're looking at, is a fixed rate, and it generally is a little bit lower than the 30-year fixed rate or 20-year fixed rate, 15. So that's a good question too. Tons of products out there. You really want to talk to your lender and get a good idea, especially based on where you're wanting to buy, what type of home, and what your budget is. Any other questions?
Next question. Greg would like you to talk a little bit about bank repossession if you have any tips.
Okay, bankruptcies. Generally, rule of thumb is if you've had a bankruptcy, 4 years out of the bankruptcy, to really even and reestablish credit to since the bankruptcy, because what happens if you filed a bankruptcy? Your lender is going to make sure that you're no longer in that type of financial situation and you've been able to reestablish some credit. Okay. Now I do say 4 years. That's going to be generally the minimum. When I was talking about TVFCU being able to do loans in-house, our portfolio, sometimes we can look at maybe 2 years. It's going to depend on what the situation was then, and where you're at right now as far as reestablishing credit. And that's another thing that I do get, being working for the credit union. Something that's great with the credit union, what we do is we work with our members either that do not have credit or have had bad credit in the past, we have loan products, not in the real estate department, but in our consumer loan department, where we have loans that you can do to help you rebuild your credit. One of them is called a share secured loan. And if you can Google that and see what that is, that's a way basically of borrowing against your own money and setting that up with TVFCU or any other credit union, or I think some banks also do these, but it's a way to establish lines of credit that report to your credit bureaus. So it's a great option. The interest rates are generally a lot lower than like a credit card. Let's say you've had a bankruptcy and you're trying to reestablish credit, and you go out and get a credit card and, take on some debt and try to, show your payments and everything that and rebuild the credit. Car loan. Well, you may want to also consider the share secured loans, because those are great vehicles. They're installment loans. The interest rates on those are super low. So if you're interested in that, and you do talk to one of my originators here at TVFCU, they can kind of point you in that direction too. Now, foreclosures. That one's kind of a tricky one as well. We'll want to look and see, when you're talking to your lender, and see what happened, how long that's been on the foreclosure. Again, it's depending on what type of loan program you're looking at and the time periods on those. But you'll want to be open with your loan officer, your lender, and let them know, hey, before you even pull my credit, this is what happened, several years ago, had a foreclosure. In some instances, might need a letter of explanation to give to your lender to kind of go with that story, what had happened then and what you've done since then. And, hey, I had this foreclosure, I had a bankruptcy because the crash of 2008, and my business suffered for several years, had to close the business, had to declare bankruptcy. But, I've reestablished, I've got income coming in. My credit's been great past 4, 5, 6 years. A lot of the times on loans like that, if we can't go through an investor secondary market, we can look at it on our portfolio and try to see if we can make an exception on some things, whereas Fannie Mae, Freddie Mac, FHA may not allow that. So do keep that in mind. Main thing is talk to your lender and let them know, what has happened and what your credit's looking like. And then again, that goes back to when you're looking at your budget and planning, you'll want to see how your credit looks. And if there's anything that's in the past, do let your lender know that up front, and they can kind of, let you know, hey, this program, we can try this one, but it may not work, but we could go to this program and it would work. Okay. Very, very good question, actually.
Next question. Oh yeah, there's more. From
Great.
Hillary. From Hillary, she asks, how would you suggest to save for down payment, closing costs, home inspection, appraisal, etc.?
Great. That's a really good question. Well, again, it's going to depend on the purchase price and loan amount. Most of your big lenders, Fannie Mae, Freddie Mac, secondary market investors, they're going to require 5% down at least. 20% down is the best, but 5% of that purchase price. That being said, the Home Possible, has a smaller down payment. Our 100% no money down product has no down payment requirement. Again, closing costs though, you'll want to talk to your lender. TVFCU does not charge for an appraisal currently. Okay. Most of your lenders are going to charge you for an appraisal up front. You're going to have to pay for it. We currently are not doing that. We're running a special right now. We will pay for your appraisal. We also pay for your credit report fee. So it's about a $500 savings that you don't have to pay out, but you'll want to talk to your lender to kind of get an idea of what your closing costs would be based on where you're purchasing the home. Is it going to be in Walker County, Georgia, Catoosa County? Is it going to be in Hamilton County, Bradley County, Meigs County? Or it's going to be in Nashville. If you're a member and you're looking to move to Nashville, we'll need to know where you're moving, what type of home you're buying, the purchase price. We can kind of give you an idea. Generally now, this has been a rule of thumb for years. 3 to 5% of the loan amount is going to be your closing cost. But again, that's a very rough rule of thumb. I really recommend talking to your lender. You can get more of an idea of what those costs are going to be. Okay. That way you can nail down. That being said, those funds that you're going to need for closing costs or down payment, those funds, unless it is a gift from a relative, those funds will need to be in your name. They'll need to be sitting in some type of an account where it can be verified. And those funds will need to be in your name at least 60 plus days too, unless you can show where those funds came from. There are some big rules out there, like as far as cash. If you have cash in a freezer or what we call mattress money, you hide it under the mattress, or you have in a safe deposit box, those funds are not verifiable. Most lenders, including TVSU, in most cases, not going to be able to use that money. if you are planning on purchasing a house in the next 3, 4, 5 months, if you have cash, you want to go ahead and get that in an account. That way it can sit there and it can be sourced. That means the lender can see where the money is, and it's seasoned. It's been in there long enough to know that that wasn't cash deposited in the account, and then that is your money. There are no loans that have been taken out. You didn't borrow the money against a credit card, which is another no-no. You don't want to be borrowing funds on unsecured collateral, like signature loans or credit cards. You can borrow money for down payment and closing costs against, say, if you have a car that's free and clear and you don't owe anything on it. Let's say it's worth $8,000 and you can get a loan for $5,000 against it. You can use that money as a down payment or closing costs because it's secured against collateral. Same thing with if you have a home, you can use that money like a home equity line of credit. Use that money towards your down payment or closing costs. So do keep that in mind. If you're talking down payment and closing costs, do let your lender know where those funds are coming from and if those funds have been in your name for a certain amount of time, because they do have to be sourced and seasoned. That being said, also too, if you're going to be using funds from a payroll down payment or for a down payment or something like that, do let your lender know that too. Okay, we'll have to note the file. Funds were deposited. And we can see it especially if it's direct deposit. Okay, but do talk to your lender about that. It's very, very important about those funds, where they are, where they're coming from originally, and where that money is sitting right now. Some people also use retirement funds. They may borrow against a 401k or an IRA or something like that. Make sure that you do talk to your investor that you can use those funds for a down payment or closing costs without any penalty, or if you are going to have to pay it like a tax penalty, you know it up front what you're going to be paying. So, and let your lender know, hey, I'm using money from my 401k for my down payment or my closing costs. Okay, that's an excellent question. We run into that a lot. A lot of times people get pre-qualified and they'll say, well, my money is, I've got $10,000 to put down. Well, then come to find out that money was coming from somewhere else and they didn't let their lender know. So let them know where it's coming from. That way we make sure that your pre-qualification is valid and it's not going to cause a problem with you getting approved. Very, very important. Lines of communication. Keep those lines of communication open. Good question.
Next question, what FICO score qualifies you for a loan?
Okay, that's another one we get a lot. Most of your mortgage lenders in the United States, including TVFCU, we're going to pull all 3 credit bureaus. Okay, when we pull all 3, we take the middle credit score on almost all the loan programs, except for home equity line of credit. That's a different one. We're not going to talk about that later. But generally, all your lenders, including TVFCU, are going to pull all 3 credit bureaus per borrower. Okay, and they're going to use the middle credit score of each borrower. Now, if you have 2 borrowers, they're going to take the lower middle score of the 2 generally. So keep that in mind. If there's a husband and wife and they're applying for a loan together, let's say the husband in the past had some poor credit and his credit is not as high as his spouse's. It could cause the approval to be less than what they were looking for, or their interest rate could be higher. So do keep that in mind too. Sometimes, people, they're like, well, he's had a bankruptcy or she's had a bankruptcy, or, spouse had a bankruptcy in the past and they've only become recently married. So they just do the loan in one name. So do let your originator know that too up front. Now, score wise, generally it's, especially with TVFCU, we do loans in-house, portfolio lending. They are score driven, but we also look at stuff on a case-by-case basis too. But generally, if you want to do the no money down payment or no money down portfolio loan that we keep in-house, generally that's a 720 or better credit score. Okay. Usually your minimum credit score with a lot of lenders is going to be 620. If it goes below 620, it's very hard to get an approval or anything that's something that's workable for the borrower. It may require 20-30% down sometimes if the credit score is that low. A lot of times when we're talking to borrowers and they have lower credit scores, the originator can kind of point them in a direction what they need to do to get to a higher credit score to get better terms. Because even though you're ready to buy a house, if your credit is not in the best of condition, you can't get approved. You'll want to see what you need to do maybe 6 months, 12 months, 18 months down the road to where your credit's going to be better shape. You can get better terms. Okay. I also do say, a lot of times when your credit scores are in the mid 600s, you may want to take a little while and work on that credit to improve it to where you can get the best rate possible, the best terms possible. Generally, if you have a 740 or higher credit score, you're going to get a lot of times the best terms possible to someone. Let's say you have a 745 credit score to someone that has an 810 credit score. Generally, you're going to get the same terms, the best rates out there and the best terms out there. So that's a good question. Again, there's not a hard and fast rule on these programs a lot of times, especially with your Fannie Mae and Freddie Mac lenders. Because what those companies do, you use an automated underwriting to get approved. Whereas TVFCU, we do those programs, but we also do the portfolio lending too. So, very good question. That one comes up a whole lot. Next question.
What happens to your loan when you sell a home? For example, what happens if you have a 10+ year loan, but you only live at the property for 5 years?
And you're selling the home and you had a 2-year loan. What happens is if you're selling it, you will have to pay that existing balance off. Okay. So let's say I live in my home and I have a 10-year loan and I'm 5 years into it. And the balance is, let's just say I started out $200,000 loan and currently I owe like 130. Okay. So I have 70,000 equity. I sell the house for 200,000. The new buyer of the home, I have to make sure that old loan is being paid off. It has to be free and clear to be able to sell that home to another individual person or entity. So the loan will have to be paid off. So the seller I'm buying the house from, they're going to pay $200,000. However, that loan has to be paid out of that, and I will get the remainder of it. I'll get the equity. Also, keep in mind, especially when you're talking to your realtor and you're wanting to sell. Realtor fees. You'll want to discuss that with your realtor. What are the fees? What are they charging that will come out of the purchase price of the home? So do keep that in mind as well. Also too, you want to keep your taxes paid up, property taxes, no liens on the property. If there are any liens on the property that you on a loan or something you didn't pay for, and it's a valid lien that's on your property, that's going to have to be paid too. Just because the new buyer is going to want to ensure that title is clean. There's nothing owed from the previous owner or owners on there. Okay. So it's a good question. Very good question. Next question.
Next question is for Greg, and he's the one who asked about bank repo earlier, but what he actually meant was, is it better in buying bank property that's being repossessed?
Okay, buying foreclosures from an entity. It can be. Sometimes you can get a really good deal on those foreclosures from bank property. It just depends. I know with some institutions, they'll use a realtor to sell the home. So it's going to depend on the condition of the collateral. Some of these homes that haven't been lived in, sometimes they're going to have issues if nobody's lived in them. Now, I would say we're not having that as much because it's such a seller's market. People are buying up properties. You have a lot of people that are doing cash sales. They're buying properties and they're fixing it up and they're selling it once it's been fixed up. But yes, you can get a good deal on those. I would caution though, if there's any issues with the property, chances of getting it financed are going to be a little bit difficult, to be honest with you. I know with TVFCU, the very few what we call REOs, real estate owned property, that we have foreclosures. I mean, again, we don't have a whole lot. If you're looking at purchasing in it, we want to look at maybe being your lender if we could possibly, because it's, again, that home is on our books. We want to sell it and we want to get somebody in that home. So yes, we would like to talk to you if you're interested in one of our properties that we have for sale. And if you're interested in one of our properties, we can be reached at the real estate department at 423-634-3667. And we can get you in contact with someone to let you know about any real estate owned properties we might have. Good question. Very good question.
Okay. Since you just said it, but the next question is, could you please share your contact information, phone number, and email address?
Yes. 423-634-3667 is directly to the real estate department or the mortgage department at TVFCU. Also, we can be contacted on our website, tvfcu.com. We are the largest credit union in the Chattanooga area. We're also one of the largest mortgage lenders too. I think right now we are number 2 spot right now as far as mortgage lenders in the 13 county region, Chattanooga area. Again, we've been doing this a long time. We have a staff of 11 originators, if I'm not mistaken, myself as a sales manager. We have underwriting that's in-house. We have processing that's in-house, closing departments in-house, and a servicing department that's in-house. And again, we're located at 535 Chestnut Street. But yes, you can reach us at 423-634-3667 or at tvfcu.com. Next question.
We do have a couple more questions, but because it is almost noon, I'm going to go ahead and launch the poll, and people can complete the poll while we continue with the questions.
Okay.
For folks on the call, if you complete the poll, you'll be entered in a giveaway for an HP touchscreen laptop computer. So here goes. It's just a few questions, should take you less than maybe 3 minutes. And while you guys are doing that, we'll keep going. The next question is, does TVFCU have a program that helps people get to pre-qual status?
Yeah, well, it's not necessarily a program. It is talking to your lender, your originator, to get you to the pre-qual status. Again, we're going to try to get you the pre-qual status when you call us and when you apply. We'll definitely try to get you fit in the right program for you. However, some instances you may not quite be ready. My originators can point you in the right direction where to go, or you can call me directly. I'd be more than happy to talk to you. Again, 23 years experience. Some of my originators have 30 years experience, more experience than I have. So we've seen a lot. We know what our programs are and what we can get you to a yes. You might be at a maybe right now, or we might pre-qualify you, but the terms are not really what you're looking for. You're looking for something, either longer term or a larger amount, but we can't pre-qualify you currently based on income status currently right now, debt to income ratio, or your credit file. Your credit scores may not be quite up there. We can kind of show you, hey, this is what you can afford right now. If you could do this, this, and this in the next 6 to 12 months, you'll be in a much better position. Check back with us and we'll look at it again. We're more than happy to. Getting pre-qualified costs you nothing. It is zero. A little bit of time filling out an application, possibly online or over the phone. Again, doesn't cost you anything, just your time. You do want to have some of your information up front if you could, just because it's going to save you time. It's going to save the loan officer time, and then we'll be able to get you a better answer faster. So definitely want to have your ducks in a row, as they say. Next question.
Any tips on buying without a realtor, buying directly from the owner?
That's a little bit of a tough one, just because the market we're in right now. It can be done, and I know some friends and I know some loans that we've done where they didn't use a realtor. A lot of times those are going to be, if they know someone they're going to be purchasing from, or a friend or family or neighbor, or just word of mouth, they found a property. We're seeing quite a bit of that, actually. Or if you're buying from a relative, we see that, and you don't use a realtor. Now, I would say, there's some different websites you can look up to give you hints and tips. I personally say, do your homework first on the home. You'll want to look and see, if that home is worth what they're selling it for, because that's one thing a realtor does do. They do an analysis. They look at comparables to see, if that purchase price is even close to what the house might appraise for. Of course, you may not have that information because you're not having a realtor, but you can use some, websites like Zillow and places like that. The tax assessment, that's all public information to look up, tax assessment value. Again, Zillow, you can look and see, what the home sold for 2 years ago or something like that, and kind of give it a base on idea on that too. If the home was sold for $200,000 2 years ago, and now they're selling it for $500,000, what have they done to that home? Has there been any major home improvements? Have they flipped the home? You'll kind of want to ask on that too, because that's a big thing too. When you don't have a realtor, and that's one of the jobs the realtor does, is do their analysis to see if the home is worth that. But yeah, do your homework. Also too, you'll want to talk to a title company, and you'll be executing a purchase contract. So a lot of times the title companies can help you with a purchase contract if you don't already have one. I do recommend on your purchase contracts that you do have some stipulations in there. If the house doesn't appraise for enough, or if there are any title issues, any earnest money can be refunded, or if you get turned down by your lender. So you want to make sure you've got your bases covered and you're protected too, because that is a legal binding contract once the seller and buyer both sign it. So you want to make sure if something happens that, if you put $1,000 down for earnest money or $500 down, and let's say when they do the title search, there's, $300,000 worth of liens on there that the seller owes. And, it's basically, and the seller can't pay it. It's going to kill the deal and the purchase and the contract. Make sure you can get your earnest money back. So you want to make sure you have that in your contract. If you have a contract you want to use, definitely, go with that, but just make sure you're doing your due diligence and your homework too. Again, I highly recommend using a realtor, but if you can't, and you can call us, talk to an originator if you have any questions. Again, we are not realtors, we are lenders. And we don't give, financial advice or anything, or advice as far as legal advice. But, we can kind of give you an idea of what purchase contracts we see, kind of give you an idea. But again, protect yourself. It is a legal binding contract. You could lose your earnest money if the contract's not written a certain way. Okay. But very good question. Very good. All good questions.
Okay, this looks like the last question. What's a
Okay.
good timeline for finding a realtor and lender looking to move in October, for example?
Oh, wow. So wanting to move in October. Personally, if it were me, I would go ahead and talk to a realtor. I would go ahead and get pre-qualified. Even if your letter does not last until October, at least you've got an idea. Hey, if my financial situation stays the same or gets better between now and October, I'm still good to go, making an offer on a home in October. A lot of things can change between now and October, but at least you know where you stand right now. I would highly recommend going ahead and doing that as soon as possible. If you are dead set, you're wanting to purchase or move in October, let's just say you live in Florida and you're wanting to move to Chattanooga in October, go ahead and get in contact with us, preferably, or a local lender, and see if you can't get pre-qualified now to make sure you're good to go. Because if there are any issues with your credit or income or anything like that, at least you know now, and you can be working on that between now and October, hopefully to fix it or be in a situation where we can be ready to get pre-qualified then. But yeah, now time is of the essence. Any other questions?
Okay, that's all the questions.
Okay.